Hey, welcome everybody. It's actually Saturday, July 20th, but this is the general market update for July 19th. I mentioned on X that I had a problem with three of the keys on my keyboard were not working, and I couldn't actually make some slides. So here we are today with the market update. So as a reminder, the presentation is all for educational purposes. And our agenda is, and kind of the theme is this a false start or are we off to the races? So we're going to talk about ranking insights, industry action, breadth, and rotation. And I'm going to try to identify a couple of sectors that are moving and a few names to watch. So just a quick update. We've launched. Those of you that are not yet aware of this, the website is up. Go to the early bird page and you'll see some of the specials the first week that end on Monday night. So just a quick reminder, there's a lot of different memberships, but you can gather information there. There are discounts for the early bird period, as well as I'm offering some special discounts on selected research reports that I've never really shared with the public before. So you might want to check that out. And also a reminder that the GMUs, these are going away to the public. You'll need to be a member at the basic membership level in order to get general market updates. I will put the public version out the first of the month. So the last public one will be the first week of August. Lots of free content on the site. So just get a free membership and you'll get access to all of my short form videos and other videos, other talking and speaking engagements will all be free to you. Okay, so with that out of the way, let's get into the industry action. It was a very, very violent week in the market with a lot of sharp rotations. So here's the S&P 500, cut this about noon yesterday. Um, we've come down and we have finally closed below the 20-day moving average, which is important to us as growth stock investors. So that's definitely a caution that the trend has lost momentum. Now, what's positive is the breadth in the past week and a half have really, really improved under the surface. Now, the net new highs started to explode higher, which is exactly what we want to see. But it's really an odd situation with net new highs exploding, yet the index is coming down. But that's all because of this concentration in NASDAQ 100 stocks that are in the S&P. So we are seeing a little bit of easing in the net new highs, but it's still strong. So the question is, what's happening under the surface? Where's the money going? Now here's the NASDAQ, same time frame, daily chart. We had a bunch of pullback warnings, the last month or so about things were getting very, very stretched. Now even the NASDAQ composite is slipped below the 20-day moving average. And this is really because of the Mag 7. The Qs have come off very sharply. And we're going to talk about that a little further. That could really mean we're in for more of some sideways action for a while. We're starting to see distribution days. So we'll keep our eye on the NASDAQ. It certainly looks like the NASDAQ is going to be rotating from being the kind of the leading index to maybe taking a back seat for a while. So here's the NASDAQ 100. Here's the Qs. I think this is good to understand what was happening and some of the learning we all can have with studying it. So, the Qs were leading the way up as breadth was still very poor. And one of the concerns we raised a couple of weeks ago was, we started to see 1, 2, 3, 4, 5 new highs in a row, but the volume was really not great. It was below average, not good volume, which is really an early sell signal to be cautious. And then we got this very, very bad day off the top. That was a negative day with volume really exploding. So that was definitely another warning sign across the bow. Then we got this very, very weak rally, 1, 2, 3. You can see very stalling each time we tried to rally back up, and the volume started to get lower and lower, saying there just wasn't buying demand anymore and things were getting exhausted. Then we had the gap down on very heavy volume and then ensuing multiple days down. So the Qs have really sold off. There's definitely money that's been taken out of the Qs. And this is a very, very sharp decline with a gap. We're down to almost the 50-day. We're probably going to get into the 50-day and it might even go below the 50-day a little bit. It's going to take time to repair that damage. So this is really all about the leading group. The one or two groups that was still sectors that was still performing was the semiconductors led by NVIDIA, which we're going to talk about. But we noticed that the relative strength line right here was not confirming this attempt at new highs, that all of these signs are part of the puzzle. And that's what was telling us that, the end of the run was probably near and that there was exhaustion and that the group was probably ready to roll back over. So let's look at breadth and a quick look at some sentiment. So I pulled up the S&P 500 equal weight here. And what I think is important, we're trying to look at under the hood. What was the breadth doing? And then when I talk about breadth here today, I'm talking about advancers versus decliners. And I'm just taking the advancers, dividing them by decliners to get a ratio. So last Wednesday on the S&P, the New York Stock Exchange, breadth was very good. It was 3-to-1 an up day, meaning there were 3 advancers for every decliner. So that's very, very positive. And then we had another very good day on Thursday. We actually had a 6-to-1 up day, which is very, very powerful. And you will all probably well aware that the IWM, the small caps, exploded higher on that day. And then follow through came on Friday. We saw another 3-to-1 up day on Friday. And you can see here, this is the S&P equal weight was starting to make its attempt to break out, and it did. Broke out on Monday. We had a little bit of a stalling action, which is typical at old highs, but we had a really big surge in net new highs on the market. So that was really positive. And biotech, which is more of a speculative sector, was also up 1%. And then Tuesday, another positive breadth day. We had 4.2-to-1 advancers over decliners. So this sequence is very, very powerful. And then obviously this week on Wednesday was the big semiconductor sell-off, came off extremely hard. I believe it was the biggest sell-off in semiconductor since March of 2020 with the onset of COVID. And the XLK came off very hard, almost 4% on Wednesday. And then you can see here, even this early attempt to rally reversed very, very quickly, and really was big tech was being sold off pretty aggressively. And even in the S&P, we have some big tech names like Microsoft and NVIDIA. So what was this really, this thrust is what we're looking here. And there's a lot of chatter on X and some other news about, hey, this was a Whaley breadth thrust. And the question is, was this a really powerful thrust or was this something else? So let's take a look at this a little further. To give you a little bit of information, a Whaley breadth thrust is basically, could be 3 components. I'm not going to get into all of these. If you go back to the January 2023 videos, there is a number of videos that explain this a little more detailed. But today we're looking at component number 1, because this is the one that really triggered this past week, the advanced decline thrust on the NYSE. This is where you have a 5-day running total of advancers over decliners combined. And it's really, really powerful. So we just showed you that it was powerful. The question is that meaning we're really thrusting off to the races here again? Now, this whole concept of the breadth thrust Whaley is really used with coming off a major bear market when you're trying to get some really push and lift to get out of there, like a follow through day. And usually the S&P is off at least 20-25% for a breadth thrust. Now, down here, some statistics from 1970 to 09, there's only been 12 signals of the Whaley breadth thrust. And then most of them you'll see are coming out of bear markets and declines. So the last thrust we had was in January 12th, 2023, which was right after the market bottom in October of 2022. So it fit the bill that this was a major change on January 12th, that the market was shifting to a bullish uptrend. So with the thrust that we just got, given the context that we were not in this context, this signal we just got might have been one of more of exhaustion from an extended market versus a thrust from a bear market. There's been a lot of rotation. I'm not saying that anything is topped here, but the rotation are violent, and they're going to take some time to sort through. We've got an election coming up in the fall, which could change policies, and hopefully those policies extend the bull market with interest rates coming down. So I put together one slide here. This is for sentiment. This is the put call ratio on equities. And I've just put a couple of lines. Generally, when things get above the 1.0 line, meaning there are more put buying than there are call buying, that's usually bullish. When people are really scared and they're buying lots and lots of puts, that means they're very afraid that things are going to go down. And that can be a sign that you might be near a market bottom. Um, Conversely, when you get at very, very low readings of put buying, nobody wants to buy put buying, or think of it as lots of people are probably buying calls. That's very bearish because it means nobody's buying a put. No one has any fear. They're confident. They think the market's going to go up. That usually means we're going to correct. So it's a very, very contrary indicator. So you can see here, we're way down here, meaning there's nobody buying any puts. There was no fear in the market in the first 2 weeks of July. The sentiment was saying everybody felt that things were going to be very, very strong. And you can see we've come off with a very sharp correction in the Qs. Last time we had this was back in last November, December. Everyone, again, there was hardly any put buying. People were very, very bullish. And then we, as you remember, we started the year and we had a sell-off. And that sell-off made people very fearful. And we had this big spike with put buying. So the extremes are what's important to us on this kind of oscillator. Just means that, when you put the pieces together, it was telling us that people were getting a little overheated with the excitement over the Qs. So the leader has been NVIDIA. Just want to recall how we were looking at this as it unfolded. Back on June 7th, everybody was really, really, really enthralled with NVIDIA, and as probably one of the most historically powerful moves we've ever seen. But there were a lot of signs that things were potentially going to slow down. And we were trying to flag that and saying, look, try to stay balanced here. Now, 2 weeks later, on June 21st, I kind of laid out the case that we were seeing signs that NVIDIA was showing some sell signals. We had a weekly upper channel line break. We had stalling and reversal days. We had, again, this signal of new highs, 1, 2, 3, 4, 5 on low, low volume. A lot of people don't see this in their chart reading because they're very excited because they're making money every day. But this is a sign that the buying has dried up. There's not enough buying power to keep pushing the stock higher. And then you get this big reversal where people are starting to sell. So, it's at the 3 trillion valuation. We had a 10-for-1 split, which historically can, top a stock. So all these were signs back in late June that we needed to stay grounded. Now let's look at the chart today. Last week I mentioned I was looking at NVIDIA, particularly this rally, to see what was going to happen. And, it fizzled out. It turned and rolled over, and we had this big wide distribution day in NVIDIA here. And then you can see that's been really a bad week for the semiconductors with the sell-off, gap down, more declining volume. And even the RS line now is starting to decline. So even the big leader, you got to try stay objective and see the sell signals when it's time to at least take off some of your position or outright sell if you don't have a lot of cushion. So it just, this is a powerful stock. It just needs to probably base out and correct. You can see here that the stock went through a good 3-4 months of basing before the market was ready to move higher again. So lessons to be learned from watching the leader. Here's the sell signals. We had the 5 days on very, very low volume. We also had a sell signal that not talked about much, but I talk about it at Rain King Insights. It's called 3 lower lows. And that's when you get 3 consecutive lower lows in a stock that drop by 1.5% or more. That happened very sharply off the top with NVIDIA, telling you that there definitely were more sellers and institutions that were lightening their positions. Now, we're almost at the 50-day, around the 118 mark. We could undercut the 50-day. I mean, the next area of support would be down here, probably down in this 105 to 110 level. Wouldn't be unusual to see a pullback here as we base out. You can see even back in April, NVIDIA took a breather and actually undercut its 50-day. So now let's get to some of the rotation and try to uncover what's going on and what are the sectors we should be watching. And we're going to get into a couple of names that could be on your watch list. So this is actually from Sentiment Trader, but I think it's a really interesting chart. This is of the S&P Financial. So this is really the XLF ETF. And what they noticed at Sentiment Trader is long-term chart. We now have 45% of the financials reaching new highs. Very, very rare and very, very powerful. You can see it's only happened very rare occasions. And hitting new highs in the financials is usually a very, very good sign to keep bull markets going. We need the financials and we need the broker dealers doing well in bull markets. So all the forward returns from these signals has been very, very positive. So again, this is a positive chart showing us that, with interest rates and the Fed, the financials are still very strong. Now, here's a few sectors on the move that we say, where is the money going? Well, we all are probably aware of the IWM small caps, which have been dormant for a long time, had a very, very powerful move. Now, they corrected and had a pullback. Now, the question really resides in, is this pullback going to be buyable? Or was just a quick phenomenon of a powerful move and we're going to fade back into the trading range that the IWM has been in for almost a year to 2 years? So this is important to watch this pullback to see if it's constructive. Now, biotech, which is also a sign of risk on, you can see over the past, 4 to 6 weeks, biotechs have moved up the right side of a base with some power. So particularly power since the beginning of July, which is typically a strong month for biotech. So this is very constructive. We want to keep our eye on maybe some of the biotechs for strength as if we can launch higher. Home builders were in a corrective phase. They were basing and correcting. Now, with the news of interest rates, the feeling that they're going to come down sooner rather than later, that really has spurred the home builders back into action. And you got this kind of straight up from the bottom thrust, very, very powerful. Probably needs to digest, and we want to watch the pullback or digestion very carefully to see if it's constructive. And then the other sector that I've noticed is starting to gain some steam here is XLRE, which is real estate, which has not been on people's radar for almost a year and a half, almost 2 years. You can see here that this had a breakout this week. You can see it's starting in May and June, started to come off the right side of a base, and it actually broke out, and it's sitting here at some highs that it hasn't had in a while. Now, it's part of a larger chart. We're not at all-time highs, but certainly we're at highs for 2024 in the sector. You can see very strong move up, and we're going to look at that closer. So here are a couple names in the real estate sector, some names you might want to consider because the action has been pretty good. Now, I admit this is not the sexiest area. This is not a big growth area, but we need to be open to where is the money moving? Where is the opportunities in the market? So Avalon Bay, you can see here, long bottoming process throughout 2023, but you can see it looks like it broke out of a little cup with handle here and it's starting an uptrend. Simon Properties Group, also you can see here, probably stronger than Avalon Bay. It actually bottomed out way back in late 2022 as the market bottomed. You can see here we have a nice prior uptrend, and then we have a base, and this base is actually a little mini kind of VCP pattern if you look at it on a blown up chart. And it just kind of broke out. It's sitting at the breakout level now. I will disclose I have a position in SPG. And Alexandria Real Estate also similar. It didn't bottom out until late 2023 as the new rally started, but you can see it's building a base. So I guess the question is, if we are primed for a move here, with interest rates being lowered, and really it depends on how the pace of lowering rates turns out, that could spur a lot of interest in these real estate developers to put money to work in developing properties. Here's the home builders and some of the names I think within the group that look very strong. Toll Brothers, which really caters towards high-end buyers with more expensive properties. You had a really strong move the past 10 days, and it's really coming out of this base, and it's really tried to break out, but got reversed, kind of normal there to pause. But let's see if it can actually build a little handle here. Maybe it's ready to launch higher. KBH Home is already broken out. This is probably the stronger ones in the group. KBH Homes is geared towards first-time home buyers, which really is the millennials. So if we can see millennials have had a struggle with interest rates being high, they have not been able to buy houses. And if we can get interest rates to come down, I think there's a lot of pent-up demand for first-time millennial buyers, and KBH Homes, which caters to that first-time buyer, might be a strong stock in the builders. And Green Brick Partners is also showing strong action. It's broken out very strong. Watch the first pullback to see if it's constructive. I mentioned biotech earlier. The sector is looking much more strong. I'm not a big biotech buyer of stocks. I don't know much about the sector in any detail other than my chart reading, which is not great. Biotechs can be very, very risky. If I ever get involved with a biotech, it's probably one that has a product which has actual earnings and sales. I rarely ever get involved with a stock that's speculative. We're relying on FDA approvals. But here's a couple of charts that look good. Neocream Bioscience looks very good. This has been a long, choppy basing pattern, really a double bottom. Kind of tried to break out. It was not the strongest breakout. It was kind of stalling as it broke out, but it broke out, and it's kind of pulling back to the pivot. It looks interesting, and this company has real earnings and sales. Down at the bottom here, we have Halozyme, which has a special drug delivery system, which is catching really hold with a lot of different drug makers on how they deliver drugs. Again, you can see here a base, then it broke out, and it seems to be very tight accumulative action in here, and it seems to be, really moving into an uptrend. So that's one to watch. And then intracellular is one also that looked interesting to me, the chart, in terms of some of the basing action that's going on. Maybe this one's going to point to break out. Now, I will caution everybody that you'll notice that earnings are around the corner for all three of these stocks. So most cases that would say stay away from these until after earnings, but you might want to be prepared in case they have a gap up. Now, coming back to the bread and butter of kind of bull markets, we always want to be looking for growth stocks with new merchandise that's young in its company's life that really has catalysts. So I've just put a chart here of the Renaissance IPO ETF line chart here showing the last 3 years almost. And these charts that I've flagged here in green, I believe that these charts look very, very interesting at this time. And they're all IPOs that have come out in the last 2 to 3 years. And I just plotted where their IPO dates were. Some of them came out right as the market was topping in 2021, and we went through the bear. Other ones have emerged in 2023 and 2024 as the market has, gotten back into a bullish mode. So Kava, you're familiar with, ARM, Reddit, but Credo looks interesting. Bros, which is actually Dutch Brothers, is interesting. Hood, Robin Hood, Coin. There's a stock called symbol is Zeta. I think you should take a look at these charts. These all look to have constructive charts, and maybe we'll cover them a little more detail in future videos. So the summary, it's been a really, really wild week. So a pullback has begun in the NASDAQ and tech. The question is, how far is that going to go, and how fast is it going to happen? NASDAQ and the S&P have all broken their 20s. So that's definitely a caution line that the powerful uptrend has slowed quite a bit. So we want to be mindful of that, and we're trying to figure out the rotations. We do have much better numbers at net new highs and net new lows. So that's constructive that money is not exiting the market. It's being rotated into other areas. So rotation is improving. The real question is, with the MAGs and the NVIDIAs and the semis really taking a big hit, are they passing the baton, and what groups are they going to pass the baton to? And we're still in a very bullish uptrend, but we really want to watch the relative strength of different growth stocks in different sectors and different groups. In general, tech might take a breather here. There certainly seems to be kind of the catch-up trade with interest-sensitive sectors trying to play catch-up. We looked at real estate, looked at the home builders. Also, those sectors might catch up. So we want to be open to those. And if we're open to trading those types of stocks, there could be opportunities, as I've shown. If you want to stay with growth and tech, you might have to wait a little longer and wait for things to set up. Exposure levels, I keep them the same. I think even though I keep them the same, and it sounds like a fairly benign um, exposure level, a lot of volatility this week. So, there were a number of stop outs and stocks that I had pilot positions in. There was the major hit to CrowdStrike this week. So, stock selection is going to become very, very important. I think tech might take a breather for the rest of the summer, particularly the big seven. So, selection is going to be very, very important. But I do think we're not exiting the market here. We're just trying to keep our levels and our risks um, kind of lower on the spectrum, but we want to stay engaged with the market. We want to see how this rotation develops because we're going to try and find out where are the next leading sectors in the market. So our quote of the week, this is by Mark Douglas of the tremendous book, Trading in the Zone. He says, not defining your risk, not cutting your losses, or not systematically taking profits are three of the most common and usually the most costly trading errors you can make. Only the best traders have eliminated these errors from their trading. Now, I've emphasized not systematically taking profits. I think when we all start out trading as new traders, loss cutting becomes the first thing that we have to learn. And it's very difficult to learn, but it's always something we all talk about. I think the second thing people talk about a lot is, okay, you got to manage risk. This is a risk-oriented business, so we got to learn how to do that. The other part of this phrase, not systematically taking profits, I think is really important. Um, Being able to take profits on the offensive side on the way up, stock is moving, such as NVIDIA or SMCI or others, not systematically taking profits when you see sell signals, offensive sell signals, or a multiple of your risk. Not doing that is a real trading error because you can give back lots of profits. So I think this is the third leg of the stool that people always can improve on, and it really, really can improve your results. So I'm speaking this Saturday today at the Traderlion Conference. My talk is at 6:30 Eastern Time. I'm bringing up the rear. I'm the final talk of the day, which is probably not the best position after people have been burnt out of listening to lots of talks. But it's a recorded session. It will be on YouTube. I encourage you to take a look. I'm talking about how to build confidence trading earnings gaps. And I'm going to specifically share one particular setup from our earnings gap course that, as a position trader, I think might be of real interest to you and will give you some insights on things to look for. So hopefully you can take a look at that. And that's the general market update for July 19th, 2024. Look forward to everybody having a great weekend, and we'll see you next week.